Hello, let us get to understand the statement of financial position, or what is commonly known as the balance sheet, and prepare it step by step, okay? And the balance sheet usually has three key items, and that is the assets, the liabilities, and equity in a business, okay? So at a particular point in time, the statement of financial position is going to tell us the assets in the business, the liabilities, and equity, okay? And this should remind you something. That is the accounting equation, which states that the assets in a business at a particular point in time will be equal to the liabilities in the business at that point plus equity, okay? And basically, in the statement of financial position, when you prepare that statement, you're going to see that the assets in the business will be equal to the liabilities and equity, okay? Now, let us go through each section to understand what do we mean by assets, liabilities, and equity, okay? Now, let us start with assets. Assets, basically, these are anything that has an economic value. So basically, it is an economic resource, okay? It has value and the business has control over, it owns or has control over that item, okay? It could be something or so it could be tangible or intangible, okay? So as long as the business has control and it has something that has an economic value, then that is an asset. And the business uses these assets to generate revenue in the business, okay? And they are classified into two: current assets and non-current assets. And current assets are those assets that are utilized within a period of 1 year. What do we mean utilized within a period of 1 year? Remember, businesses use assets to generate revenue. For example, if you take cash, like today you have cash in business, you could use it to buy inventory, you could use it to pay employees, you could use it to pay your suppliers, okay? So you see, cash is something that you can utilize even within 1 day, okay? But for non-current asset, these are assets that are expected to be utilized for a period of more than 12 months. For example, if you go buy a motor vehicle, and basically your business is not of buying motor vehicles to sell. If you're buying these motor vehicles to sell, then that is what we call stock, or rather inventory, and that lies under current assets. We are talking about you buying a motor vehicle to do your deliveries for maybe you're selling, you're dealing with a furniture. You're a furniture, you make furniture. So you just bought a lorry to deliver these furnitures to your clients, okay, or to buy raw materials. So this motor vehicle is something you buy as a business to expecting to use it for a period of more than 1 year, okay? Another example is for a manufacturing company. They go and buy land and they construct a plant and they buy the machineries. You see, these things that they have bought, they are expecting to utilize them for a period of more than 1 year. Let's say you go buy a laptop to use in your office, okay, whether it's to be used by the accountant or the HR in the business to support the business. That is what we are all referring to as non-current assets. These are basically commonly known as the PPE, okay, property, plant, and equipment. So that is basically what we refer to assets, and this is the classification of assets, okay? It is going to help us when preparing the statement of financial position, okay? Then we have the liabilities. The liabilities as well is a liability is it's a present obligation that requires you to give out a certain economic resource in future. So let's say, for example, you went and took a loan. If you take a loan from a bank, you've created a present obligation to make sure you pay this loan to the bank in future, okay? So that is what we call a liability. You go take goods from your supplier. You've already created now you've created an obligation to make sure you pay this to pay your supplier. These are what we refer to as liabilities, and they're also classified into two: the current and non-current liabilities. And current liabilities are liabilities that are expected to be settled within a year. That is within 12 months. This is, for instance, let's say you buy from your supplier. If you go buy from your supplier on credit, your supplier is not expecting you to stay with their money for a period of more than 1 year. Maybe you have an agreement of 2 months or 3 months, okay? If your employees have worked this month and you're yet to pay them, we are expecting you to pay them within a month, okay? Not more than 12 months. So these are short-term liabilities. You're expected to settle them within a period of 12 months. On the other end, we have non-current liabilities, and the most common is a bank loan that is exceeding 1 year. For example, you go take a loan of 5 years, okay? So you see it is going to take you more than 5 years to pay this loan. So this is a non-current liability. It will take you more than 1 year to settle that liability. So basically that is a classification of liabilities. Then we have equity. Equity is usually owner's share of the business. Remember, when you're starting a business, you can get a loan or you can get capital contributions, and that is what we refer to as share capital. Okay, share capital is basically those capital contributions into the business. We have share premium, that is mostly for companies that you issue a price that is above the nominal value of the share. So if the share has a value of 100, nominal value of 100, and then you issue a price of like 115, this extra 15 is going to be your share premium, okay? We have retained earnings. Retained earnings is basically the profit you pay your dividends out, or rather your drawings if it is a partnership or sole proprietorship. And then what remains at the end of the year is those retained earnings that the business keeps. Maybe if they want to expand in the next period, they can expand, okay? Then we have revaluation surplus. This comes from, for example, if you have land and you are using a revaluation model. So you bought this land, let's say, for example, at 10 million. And now when you have reevaluated, you found that your land is worth 15 million. Remember, you've not sold this land. You've just reevaluated it. You own the land. It is yours. And you've evaluated, you've seen it is of 15 million now. This 5 million is going now to be that reevaluation surplus, okay? So that is basically the 3 key items. I said the assets, liabilities, and equity. This is what you're going to find in the statement of financial position. How do we present these? Always they're going to find a header, okay? There is always going to be a header that detects the company name, that has the company name, the statement that we are creating, which is the statement of financial position, and as at which particular point in time, okay? So we are saying as at 31st December 2025, for example, okay? Then you're going to list your assets. You're going to list your assets first, and you're going to start with your current assets, then non-current assets, okay? Then you're going to have equity. You list the components of equity that are applicable in that business. Then you're going to list your liabilities, okay? You're going to list your liabilities. That is the current liabilities and non-current liabilities, okay? As long as you are able to present your assets, your equity and liabilities, mostly we start with assets, you can follow your liabilities, then equity. But basically, as long as you're able to make sure you do the classification of this is assets, the current asset, non-current asset, then equity, and then we also have liabilities, listing them, current liabilities and non-current liabilities. You're going to see in mostly for financial institutions, IFRS 18 detects that they can do, depending on liquidities, how they arrange let's say for their assets, they arrange them as how they can easily liquidate them, okay? So for financial institution, that is the banks, insurance, you're going to see a different structure, but this is the most common structure for other businesses, and they can also use it as well, okay? So basically at the end, we should be able to see equity plus liabilities. What is the total? what is the total of equity plus liabilities, and it should be equal to the total assets. Okay, now I want us to do a practical example, okay, where we've been given this trial balance as at 31st December 2025, and we've been asked to prepare the statement of financial position. Okay, following our format, we start by writing the header. As mentioned, we have the company name. We are preparing the statement of financial position as at 31st December 2025. So basically, this is the header, okay? Then we go to how to prepare the statement. Basically, when a business is preparing this, they're expected to have comparative. There should be the comparative aspect, where if we are looking at the period 2025 here, okay, then you should have period 2024 balances as well. Okay, so for teaching purposes, we're just looking at this period, but remember, when we are preparing them to publish them, remember you should always have your previous year balances as well. Okay, given those previous year balances, make sure you have them when you're publishing the statement of financial position. So now let us look at how we prepare this statement for year 2025 as at 31st December 2025. So we have this trial balance. Okay, these are the balances as at 31st December 2025, and we are going to start with the first section. We look at assets. Okay, so, and assets, we start with current assets. Okay, so under current assets, what do we have? We need to be able to look at the trial balances, that is the balances we have, and we see what are the current assets and what are the non-current assets. So for the current assets, we start here. We have land. Land is something that will be utilized for a period of more than 1 year. So this is a non-current asset. We have buildings as well. This is something you have in a business to utilize for a period of more than 1 year. And then we have accumulated depreciation. Remember, these should reduce the cost of the building, because we usually present the carrying amount, or rather the net book value. So this was the cost of buying the building. And then up to this particular point, the depreciation that has been accumulated is 600, and we need to present the carrying amount, that is the net book value. So we have to take 3 million, we less 600,000. Okay, same to motor vehicle as well is a non-current asset, because it is something that is going to take the business is going to utilize for a period of more than 12 months. Okay, and because we need the net book value, we are going to take the 1.5 million, we less 300 as well. Same to your office equipment. Office equipment is like your printer, your laptop. You're buying this so that you utilize them for a period of more than 1 year as well. That is your non-current asset. Again, you're going to reduce the accumulated depreciation so that you get the carrying amount. That is the net book value. Okay. Then now we have inventory. Inventory is basically same as, is what is also called as the stock. This is what you buy, okay, to sell. This is what you buy. If you're in a business of handling laptops, remember, the laptop that you're buying to sell becomes stock, okay? But the laptop that you're buying to use in the business, to facilitate the business, remember that is a non-current asset. If your business is to buy and sell televisions, when you buy those televisions, those are inventory or stock, okay? And when you buy stock, you want to sell it within a period of 1 month or 2 months, not to buy stock to be there to utilize in a period of more than 12 months. You are buying this stock so that you sell it within 1 year, okay? Then you have trade receivables. Trade receivables are those you've sold to your clients or customers on credit, so you're expecting them to pay you. Remember, you're not you're not expecting your client to say to stay with your money for a period of more than 1 year, okay? So you're expecting them to pay you within 1 month, 2 months, okay? Cash at bank. Basically, this is money in your bank that you can go use it to pay your supplier, use it to pay your employees, so you can utilize it within a period of even 1 day. Same to cash in hand, okay? Then we have prepaid insurance. Prepaid insurance, remember, as at that we are saying as at 31st December 2025, we had prepaid insurance of 100,000. What does that mean? We are yet to incur. So we have prepaid maybe for the next 5 months in the next period. So as at 31st December 2025, we record this as an asset, as a current asset. When we expense it now, it is reduced from our asset. So it's something that is going to be utilized within a period of less than 12 months as well. So these are basically the current assets, okay? The current assets. So we list them. We start with, let's start with cash at bank. Cash at bank. What's the amount of cash at bank? We have 1.3 million. We have 1.3 million. Then we have cash in hand. We have cash in hand, an amount of 100,000. Then we have trade receivable, an amount of 900,000. So basically here we are listing the current assets. We are listing the current assets. We have now trade receivables, an amount of 900,000. And then we have prepaid, we have inventory, and we also have prepaid insurance. We also have prepaid insurance, okay? So what is our balance as at 31st December 2025 of inventory? We have 1.2 million. We have 1.2 million. Then for prepaid insurance we have as well 100,000. We have 100,000. So as at that particular point, we've listed all our current assets. If we continue going down here, we are going to see the rest, trade payables, accrued salaries, these are basically liabilities. We're going to look at them, and this is equity. This is just to check we've not left any other asset behind, okay? So up to that point, we have listed our current assets, and when we sum here, if we come and sum to get our total current assets, that is the sum of all these items, that is the current assets, we are going to have a total of 3,600,000, okay? 3,600,000. Now let us go to the next section, that is to our non-current assets. Remember, we need to list the current assets, then we also list our non-current assets. So our non-current assets, we start with land. Remember, land does not depreciate. So we have 2 million of land. Then we have buildings. We have building 3 million. And because we need the notebook value, we have to take 3 million, we less 600,000. So our carrying amount is going to be 2,400,000, okay? So here we are going to have buildings. We are going to have a balance of 2 million. Remember, we need the net book value. And then the next one will be the motor vehicle. Motor vehicle has 1.5 million. And the accumulated depreciation is 300,000. So we are going to have a 1.2 million. When you take this, you less 300, that is going to be 1.2 million. So motor vehicle, this is going to be 1.2 million, okay? Then we are going to look at the office equipment. Equipment have 1 million. When we less 200,000, this should be 800,000. That is office equipment. Okay, so we list here office equipment. Office equipment, we have 800,000. Okay, so is there any other non-current asset left? No, we have 1, 2, 3, and 4. So here they are. So what is our total? What is our total non-current assets? Our total non-current assets is basically a summation of this, which is 6,400,000. Okay, 6,400,000. So what is our total assets? Total assets. Our total assets is basically the total current assets plus the total non-current assets, which is basically 3.6 million plus 6.4 million, which is 10 million, which is 10 million. Okay, so that concludes the first part, which is assets. So we are taking the assets, we list them, then our current assets, and then we list our non-current assets, and then the total of both current and non-current assets. Okay, so now let us go to the next section, which we're going to look at equity. Equity, what do we have under equity? Equity, actually, let us start with first liabilities. Okay, let us start with liabilities. You can interchange any liabilities. We start with current liabilities. Current liabilities. So what is our current liabilities here? Our current liabilities, we have trade payables. Trade payables is when you go and buy from your supplier, you are expected to pay them, right? When you go to buy on credit, so you are supposed to pay them within a period of 12 months. What about accrued salaries? You don't want to keep your employees unpaid for a period of more than 12 months. So this is basically current liability. Same to current tax payable. You don't want to have your tax unpaid for a period of more than 12 months. 12 months. Okay, so here we have these as current liabilities. Then we have long-term loan, basically because it is a long-term loan, this is going to be a non-current liabilities. Okay, so let us list them. That is, you've seen we have trade payables, we have trade payables, an amount of 800,000. We have accrued salaries, an amount of 200,000. Then we have current tax payable, an amount of 100,000. Okay, then we have now total. Let's do a total of current liabilities. This is going to be an amount of 1,100,000. Okay, so we are going then to list our non-current liabilities, which is basically, we have one, which is the long-term loan of 2 million. So here we have long-term loan, an amount of 2 million. Okay, so what is our total? Since we only have one non-current liabilities, what is our total liability? What is our total liability? We have a summation of these 1.1 million plus 2 million. Okay, that is the non-current liability. So we are going to have a total of 3.1 million, okay? Then now let us look at equity. Let us look at equity. So here we go to the equity section. Equity. Which components of equity do we have? We have ordinary share capital of 5 million. So as at 31st December 2025, we have ordinary share capital. We have ordinary share capital of 2 million. We have ordinary share capital of 2 million. Actually, ordinary share capital of 5 million. Sorry, 5 million, not 2 million. So 5 million. Then we have share premium. What's our share premium? Our share premium has a balance of 400,000. So we have 400,000. Then we have retained earnings. We have retained earnings is another equity, components of equity, which has a balance of 1.5. So we come right here, 1.5 million. Okay. So what is going to be our total equity? Our total equity is basically 6.9 million. Okay, 6.9 million. So to check that if the assets are equal to equity plus liability, we are going to need here to have now equity and liabilities. What our summation of equity and liabilities? We have here equity 6.9 million and we have liabilities here 3.1. When we take 9 plus 1, 0 carry 1, that is 10 million. That is 10 million. So our total of equity and liabilities is 10 million. And compare that with what we had as our total asset, that is 10 million as well. So that's how you know your balance sheet is correct. If you see it's not balancing, then you have to go back and check what you've missed. Is there anything that was not passed? Is there a balance that is not updated? You have to investigate, because the assets of a business at a particular point will always be equal to the equity plus liabilities. Always. So if this is not the case, then you have to go back and check what is missing.